In this episode, we will discuss the Zambian soybean market with quite a few developments impacting the market over the last month. These impacts were mostly negative from a price perspective. We will also discuss the latest price movements in the poultry industry of Zambia. All in this week's episode, so make sure to stay tuned. Hi, I'm Dr. Johnny van der Merwe and welcome to this week's African Agri Overview. Make sure to follow us on YouTube, where we will share regular insights into the agricultural markets of Africa. For more detailed information on sub-Saharan African soft commodity markets, however, please make sure to contact Jacques Pinaar on the information displayed. Looking at the latest economic indicators, the kwacha strengthened significantly over the last month, trading on 17.6 kwachas per US dollar. The kwacha gained some ground on speculation around government debt restructuring and potential IMF assistance. However, over the last week, the kwacha lost some ground again. A lackluster economic recovery in China, US recession fears, and robust exports from Russia and Iran weighed on oil prices, with the latest price now on $75 per barrel. But oil prices can increase over the third quarter of this year, with OPEC and Saudi Arabia that is likely to keep production on a lower level. In the poultry market, the day-old broiler price increased to 10.5 kwachas per head, while day-old layers increased to 14.83 kwachas per head. Based on seasonal trends, we are expecting broiler prices to increase over the next few months, while layer prices can start to decrease, especially since the kwacha strengthened as well. Layer cull prices increased to 55.67 kwachas per head, while live broilers also traded higher on 88.33 kwachas per head over the last month. The average egg price also increased to 51.67 kwachas per tray. We are, however, expecting these prices to decrease slightly over the next month, with the kwacha on a stronger level at the moment. In the grain markets, the latest maize price traded higher on $340 per metric ton. Soybeans stayed on $350 per metric ton. The latest wheat price, however, decreased to $490, while soy meal prices also decreased to $350 per metric ton. But with that said, Jacques will now tell us more on movements within the grain markets of Zambia.
Since our last discussion of the Zambia soy complex early May, there has been quite a few developments impacting the market, mostly negative from a price perspective. The only mentionable change to our soybean balance sheet is an increase in the 2023-24 production forecast from 600 to 650,000 tons. The Zambian government published the recent summer crop production forecast early June and put soybeans at 760,000 tons. The market feel they might be overestimating small-scale farmer yields, and the reason for our lower estimate. Remember, we guess 70% of soybean production this season will come from small-scale farmers. As indicated in our previous podcast, during 2022-23, the government bought 100,000 tons of soybeans for strategic reserves through the Food Reserve Agency, or abbreviation, the FRA. Due to their unrealistically high selling price for the stock, it remains unsold and was carried into the 2023-24 year. The past week, government announced the FRA will buy a further 100,000 tons for strategic reserves during the current season at a price of 6,000 kwacha or $340 per ton, delivered to the depots across the country. This is a very attractive price when compared to the current market price in Lusaka of 6,200 kwacha per ton or $350 per ton, as it will also be paid in outlying areas. This announcement could be price supportive, especially if the FRA starts to buy. However, rumors doing the rounds, they need to sell their old stock before they can start buying again. The market talk, the FRA is unlikely to buy significant volumes of beans this season. We have to emphasize again, soybeans is not a staple, and carrying a strategic reserve for this commodity does not make sense and probably politically motivated. The next graph shows price history of Zambian soya meal, soybeans and crude soya oil import parity from Argentina. Soya oil reads off the right-hand axis. As indicated in a previous podcast, Zambia is a net importer of edible oil and therefore import parity is the benchmark. The record expected crop has seen soybean prices slip further the past 6 weeks. See the blue circle. There was a slight uptick the last 2 weeks from $320 per ton low to $350 a ton, as kwacha strength supported US dollar denominated prices. The Zambian kwacha benefited from speculation regarding government debt restructuring and potential IMF funding. Until mid-June, observers estimated 3,000 to 5,000 tons was exported monthly to India and Pakistan via Dar es Salaam. However, this has slowed significantly with the recent uptick in prices. Current local soybean prices trading $20 to $30 a ton above export parity. The market expects a price adjustment lower short term. Interesting to note, exporters prefer exporting via Dar es Salaam compared to Beira. Sea freight is cheaper from Dar es Salaam and road freight to both ports similar. Also, Dar es Salaam is better equipped for exports compared to Beira. Soy meal prices also came under further pressure and lost $30 a ton to $340 a ton during the past month. See the blue circle. It is expected Zambia will consume around 50 to 60% of the soy meal Zambian crushers will produce. The rest needs to be exported into a low international soy meal price environment. Kenya, Tanzania and Zimbabwe are potential markets, but the majority needs to move to South Africa with stiff local competition and competitively priced Argentine imports. We get the idea. South African buyers now are demanding a discount for Zambia origin soy meal to compensate for the extra effort to deal with imports and an ex-Zambia price of $300 to $320 a ton being mentioned. The one reprieve is marginally higher international edible oil prices the last month, as indicated by the red circle on the graph, on the back of higher crude oil prices, which does give crushers a bit of leeway to discount soy meal. Unless a significant need for non-GM soybeans attracting premiums develops somewhere in the world or international soy meal and edible oil prices increase significantly, we expect Zambian soybean and soy meal prices could remain relatively low short-medium term. The large FRA soybean position, which could cause an overhang in the market after the harvest, could further limit upward price potential. General market view, Zambian soybean and soy meal prices could move in the $320 to $400 per ton band short-medium term.
Thank you very much, Jacques. For more detailed information on sub-Saharan African soft commodity markets, please make sure to contact Jacques Pinaar on the details displayed. I'm Dr. Johnny van der Merwe and thank you for watching.